In today's video, we're going to take a look at what really is happening in the rental market across Canada and even more specifically Calgary. And my reason for doing this video is because since the start of the year, there has been a very mixed opinion in terms of the reports that come out and the actual on-ground experience that people have for people who are renting. And apart from that, the CPI data shows that rents are constantly inflating, while the reports that come out show that rents are deflating. So we want to take a look at what really is happening and the ground reality, because the last video that I put out on this particular topic got way over 13,000 views. Obviously, it is something that means a lot to a lot of people, and as expenses go up in our daily in Canada right now, it is definitely a very important topic for a lot of people to understand where the rental market's going, because then it also contributes into your decision of how the house prices will reflect that going forward. As we know, house prices, especially for investors, is usually a reflection of the rents that they can actually gain. So once that multiple goes down, the house prices also come down, and then that all plays together into whether you should move from being a renter to a homeowner, and also together with how the house prices are expected to correct now that we are going more into a balanced market in Calgary. So the previous video that I had put out on this topic conclusively showed that rents are coming down across Calgary and across Canada. However, in the comments, we had a lot of people give their feedback that they are still paying increasing rents, their rents haven't come down. And this video is going to draw a lot of clarity into why that is. It is very important to understand that when a report comes out to show that rents are going down, it might not necessarily reflect what you are going through, and there is a very specific reason for that. So definitely stay tuned through this video and you will see what I mean. And if you are an investor, this video is also going to be extremely important to you to understand what that forward multiple is, what those rent increases or decreases can be for the rents going forward, because I am seeing a lot of investors reach out from projects they have found and they're trying to get my advice, but they are being promised a completely wrong picture. I've seen reports, pro forma reports for MLI Select projects where they're promising 5% increase on rents, and that is completely opposite of what is happening right now. So it is very important to have that knowledge so you can equip yourself when you go out into the market and you know what you're getting into with all the forward risks. So without further ado, let's get right into the video. So right here, we're going to take a look at the 2025 mid-year rental market update that has come out by CMHC, which is the Canadian Mortgage and Housing Corporation. And they do very in-detail research about all the different sources that report on rentals across different cities, and do a very real comparison, and also call to light why your experience might be different depending on which city you're in. So let's get started. This rental market report provides an update on rental market conditions across Canada, and it really extends from the 2024 report that they have put out previously. So overall, as you can see here, since October 2024, advertised rents have been declining due to increased supply, while rents for occupied dwellings continue to increase, but at a slower pace than they were last year. And this is really, really important to distinguish between advertised rents versus occupied rents. And those are two very different things. So if you are staying in the same apartment or rental that you were in, there are chances that your rent could still continue to increase. Versus if you move and you go back to the free market, essentially in economic terms, and you go into a new apartment or rental, then those advertised rents are generally lower, because now those landlords know they have to drop the rents in order to be able to get new tenants, because that's what's happening across the board. So sluggish job markets and decelerating migration are creating challenging environments for landlords and property managers. Purpose-built rental supply is growing. CMHC construction financing programs and products have supported an estimated 88% of Canada's new purpose-built rentals. And this is a huge topic. In fact, I am not going to break this down right here in this video. I'm going to make an entirely separate video on the huge problems that I foresee with the MLI Select program. Too much, too fast, and that's a trend for Canada. No surprises there. When they do something, they just do too much of it, and then we go completely in the opposite direction, and then we're going to have some problems. So you're going to see why that is in my next video, but that is definitely a topic to talk about. Vacancy rates are expected to rise in most major markets this year. So as vacancy rates continue to go up, rentals will continue to come down as we'll have more supply and lesser rentals, more options for renters, and that is good news. Despite easing rent growth and increasing supply, rent affordability isn't improving, especially in Vancouver and Toronto, as turnover rents are driving increases. So Calgary, however, has shown a slight improvement. So despite easing rent growth, so the people that continue staying in the same place, they are still seeing rising rents, and that is not helping the overall rental situation. And so it is not easy for a lot of people, unfortunately, to just get up and go and find another place. The hassles of packing up, especially if your kids are enrolled in schools, it can be quite difficult. However, knowing the stats, having the knowledge of what's really happening in the rental market, because trust me, even landlords are keeping an eye on this, and using that to at least drive a bargain in where you are right now is extremely important, and try to get a decrease in your rent with the potential conversation of that you would need to leave if the rents don't go down. Now let's talk about elevated supply that contributes to lower advertised rents. So rent supply has been increasing, as you can see. This has been shown by rapid growth in the number of listings and newly completed structures, and the amount of housing starts, especially for purpose-built rentals, is through the roof right now. So we can continue to see the supply constantly increasing through this year and next year. As a result, Calgary, Toronto, Vancouver, Halifax, their advertised rents in Q1 have declined by anywhere between 2 to 8%. So Edmonton, Ottawa, Montreal still continue to see a lot of people move there. That shift of people coming to Calgary, a lot of that has shifted now to Edmonton. So that's why you can continue to see an increase in advertised rent instead there, although at a slower pace. So when we look here, you can see Vancouver year over year. So this is 2023 to 24. It was going up, but now 24 to 25, it's come down completely in the opposite direction. As far as Edmonton goes, they had significant rental growth, which was 13% from 23 to 24. Even though that has remained positive for 24 to 25, it has dropped a little bit. Calgary, again, has gone in the opposite direction. It has significant rental growth, so 17% from 23 to 24. Now, 24 to 25, we are actually negative 3.5%. And remember, this is for a 2-bedroom purpose-built rental. So that is what the benchmark is for these price comparisons. So 23 to 24, year over year, still remain positive for Ottawa. And Ottawa has a lot of public sector jobs. That is really what holds up a lot of Ottawa's housing market and rental market. So depending on how those labor hiring or reduction in workforce happens in Ottawa, we saw recently they did try to reduce a lot of the workforce, especially for the tax department, but they needed to rehire a lot of people in the call center department. So there's a lot of changes that happen in the public sector. The hiring has been absolutely crazy, and I do think this is going to correct very quickly at some point, because all of that hiring and the amount of cost that the federal government has undertaken for hiring public sector workers, I think it's just not sustainable. It's a huge amount of debt, and it's a completely different topic. As far as Toronto goes, 2023 to 2024, you can see 3.8% increase, and now they've reverted completely in the opposite direction, wiping out all those rental gains that they had for the previous year. For Montreal, we have 8.4% from 23 to 24, and they have remained positive as we continue to see a lot of interprovincial migration still happen to Montreal. So year over year change from 24 to 25 to 2%, not as high as the previous year, but still positive. And as far as Halifax goes, 2023 to 2024, 8.7%. And you can see here, year over year change has gone completely again in the opposite direction. So minus 4.2%. It has corrected about half of those gains. So if you continue to find Calgary, for example, expensive, you have to understand that we saw significant gains. And you can't expect to compare ourselves right now to where we were just about 3 years ago, because our rents were significantly lower back then. So while we are in correction territory, I would say it is only, first of all, for turnover rents. If you are staying where you are, the landlord may still try to increase your rent, 100% try to drive a bargain. And if you are not able to pay those rents, then definitely try and find a new place. There's a lot of supply. There's a lot of amazing places coming on the market right now. In fact, I am also seeing a lot of landlords needing to sell their place because they were expecting unrealistic rent increases year over year just based on the growth that we had in the last 3 years. And so rents are definitely going to continue dropping. So there's opportunities for both, for first-time home buyers and also if you just want to continue renting. I would just highlight at this point, there's two primary factors if you want to go from being a renter in this market to a first-time home buyer. The two key things to keep in mind is, can you get a home for something that's very close to already the rent that you're paying? So in that case, instead of paying someone else's mortgage, you pay your own mortgage. But then you might ask, aren't we in a dropping market where the prices are dropping? So when I buy, the next month the prices are going to come down even more. And that is true. So what you want to do is, because we are in a balanced market, you want to drive a hard bargain. So if you're able to get a huge discount on the list price, that's going to cover all your losses for the next year and cover your equity pay down. So if you calculate basically how much you're going to pay every single month, multiply that by over a year, and if that is going to be more than the losses that you're going to take, then technically it is still better to own, because now you've paid down your capital. The losses just cancel out against that. So the balance, the buffer that you still have over your capital pay down is still more money, and you would have given all of that away to a landlord anyway. So there are a bunch of calculations based on your own personal financial situation. And if you've really started liking a certain neighborhood and you know you're going to stay there for a while, now between this year and I would say next year is a great time to get a lot of good deals, as we see a lot of supply increase come on the market. But that again is a topic for another day, where if you are a buyer, definitely reach out and then we can have that consultation call to see what's best for you, whether you should remain a renter or whether you should move on to being a homeowner. Now let's get on to the next piece of this article. So as you can see, this is now based on a 2-bedroom condominium rental. So the previous one was a purpose-built rental. You have to understand, purpose-built rentals operate very differently from condominiums. Purpose-built rentals, first of all, the rents are generally always higher because these are owned by larger corporations and are rental management companies. On top of that, they are very slow to correct their rents. They generally provide a lot more amenities than condominium rental markets, and so they generally charge that premium and they keep their rents high until they absolutely have to drop it. So right here you can see these ones are fastest to correct, and they'll correct in more markets. So in Vancouver, year over year, we had from 2023 to 24 a 1.2% increase. However, from 24 to 25 was a 4.8% decrease. So completely in the opposite direction, wiped out all those gains and even more down. Edmonton went up by 10% from 2023 to 24, and it continues to go up, but only at 2.9%. As far as Calgary goes, we had a year-over-year increase from 2023 to 24 at 10.7%. And now from 24 to 25, we've actually come down 3.6%. So we've definitely not come close to even wiping out that single year gains, even though we've had even more gains in the years before. So rents are definitely relatively expensive if you've been in the city for a while, but they are coming down. And Ottawa, you can see 2.9% from 2020, sorry, it's 3.8% from 2023 to 24. And they continue going up at 2.9%, so not as close as last year, but they're still continuing to have healthy gains. And as far as Toronto went, they dropped last year and they're dropping even more this year at 1.7%. Montreal sees an increase across both years, so 2.4% the year before, and now in the last year 3.8%. Halifax, completely opposite direction, and huge gains, huge losses. So 11.7% from 2023 to 2024, and then this year they've almost come close to wiping out those gains. I expect they will. So it's at minus 8.3% for this year. Now, before I go on, if you are a buyer in the Calgary real estate market, whether new construction or resale for the next 3, 6, and 9 months, it is extremely important that I call out the 2 guides that I offer. It's down in the description. You can either scan these QR codes right here and get them straight to your phone, or you can click the links in the description. One is a buyer guide and one is a community guide. Both are extremely valuable. The buyer guide goes into not just the process of buying a home in Calgary, but it also goes into the psychology of a buyer, how and what you should be able to afford, and how you should approach the whole buying process as a whole. And as far as the community guide goes, this is one that people rave about because it goes in depth, not just about individual communities, the pricing, but also what the vibe check is. Does it suit the lifestyle of you and your family? What kind of expectations you have after you buy a home in that community, what the neighbors are going to be like, and what people think of those neighborhoods when they live there. So this covers everything, and it's the most popular one, so I'm sure you will love it. Make sure to grab both of these guides down in the description. And now let's continue with the video. Now let's take a look at this article right here. Landlords are reporting that vacant units are taking longer to lease. So that's where you have those bargaining rights, where you can really drive the prices that you actually want to pay, and you're comfortable getting into that lease, because guess what, there are a lot more options available, especially in the case of purpose-built rentals in Toronto, Vancouver, and Calgary. Due to additional competition from well-supplied secondary rental markets, owners in the secondary rental markets are often more inclined to lower units to avoid vacancy. So small mom and pop landlords cannot afford to have additional mortgages. They cannot be paying their primary homes plus those additional homes, and so they're faster to lower your rents, and then very soon after, the purpose-built rentals need to follow. So because they need to compete with these mom and pop landlords, so placing less emphasis on capitalization rates. In contrast, purpose-built rentals are responding to market conditions by offering incentives. So instead of actually dropping rents, they are capable of providing additional things that are then essentially averaged across all their rental units. So they provide you things such as a 1 month free rent, moving allowances, so you get your moving truck and all of that stuff, or signing bonuses, because they can average this cost out, they can write it off, versus trying to drop your main rent. That is more of a problem to them. Nevertheless, some operators anticipate that they might need to lower the rents over the next couple of years. So this is good news for a lot of renters out there. CMHC data indicates a continued increase in rental completions since our rental market survey was conducted in October 2024. So they remain at a 10-year historical average for most markets, which has been encouraged by government initiatives. And they are really underplaying this in terms of how they're trying to show it as a good thing, because of course they are the ones actually promoting all these rental units to be constructed. But there will be some negative consequences, as you do still need to have a healthy level of competition. But if you oversupply a market, it can go completely the other way. So CMHC's role in boosting multi-rental construction. So as you can see, they, of course, patting themselves on the back. CMHC products have essentially played a key role. So that's the MLI Select product program that they are talking about. And it estimates that in 2024, new rental apartment starts in Canada was supported by 2 primary programs. So you had over 200,000 new purpose-built rental units that were funded by CMHC's multi-unit mortgage loan insurance programs and the apartment construction loan program. So, and this essentially grew significantly. These numbers are crazy. So it grew from 5% in 2017 to 88%. That is a very short span of time. So as we can take a look at here, the total amount of rental apartment starts from 2017, it was only 5.4%. The MLI program was barely 1,786 units. And that completely got wiped out by the MLI Select program, which is now at 66,000 units being completed. That is a massive number. And I know we talk a lot about housing shortage and everything, but I will go into depth why this is a problem, because this is all happening at the same time that we are seeing reverse migration, huge drop in international migration numbers, because the housing shortage really was because of international migration and the number of students that were coming and the temporary worker program and all of that. And all of that is being cut at the same time that a supply is happening for a market that is seeing a reverse in demand. So the effect of this is going to be in multiples. Now let's go right here. So you can see 2017, the share of rental apartment stats that was supported by these programs has grown across major markets across Canada. And Montreal actually experienced one of the most significant increases in 2024, driven by the MLI Select program. So they are the key one that will be affected. And then in more expensive rental markets like Toronto and Vancouver, the uptake of ACLP remains more important. This aligns with the program's focus on increasing rental supply costs, and this is good at a time actually that we are seeing a huge amount of inflation costs, so this is going to help a lot of people. Edmonton and Calgary represented the second and third highest number of issued new units, so Calgary is definitely in there. So if you're a renter or you're looking to invest, these are stats you definitely want to keep an eye on. This strong uptake is largely due to the ease of meeting of the MLI Select program, like we highlighted. Now let's talk about the migration trends and how that is going to affect things. The impact of a slower international migration is observed, and a recent decline in advertising rents. So after peaking around 2023, mid-2023, advertised rents fell for most markets, most exposed to such changes, such as Vancouver, Toronto, and Halifax. So those are the top 3 markets that will get affected. But Calgary for sure, especially based on the huge amount of international migration we've seen in the very recent years that led to exponential growth both in house prices and rents. So there's going to be a short-term correction 100% for that. However, these markets are the ones that have been exposed for a longer period of time, and so they're going to see a huge reverse of all those trends. The cap on international student intake and adjustments to the provincial distribution are influencing rental demand in British Columbia, Ontario, and Nova Scotia. These provinces all saw a decline in work and study permit holders for Q1 2025, while the growth in the number of non-permanent residents also slowed in Quebec and Alberta. So demand is softening due to sluggish labor markets. So the labor market suffering, lesser students are coming, it's become less appealing to come to Canada, and at the same time the programs are also doing that together with all the political situation that is going on. So there is a huge reverse in terms of demand. New entrants to the rental market are hampered as youth unemployment is above its 5-year average across most markets. So the later labor market that came out, the huge amount of unemployment numbers, close to 40,000, and 17,000 of that was in Alberta. So there's a huge high amount of unemployment, and a lot of that is for people between the ages of 14 to 24, and those are usually your renters. So international migration people, they are not looking to buy a home right away. They want to rent first in the city and understand where they can fit in and what part of the community they want to live. And then at the same time, you have people just entering the job market that are not able to find jobs right now, also suffering to find rents that they can afford. So it makes sense that the rent should come down to adjust, and we need a correction across the market. However, labor market trends vary across markets, of course. So labor markets in Vancouver and Toronto are showing some signs of weakening, while conditions remain relatively strong in Halifax, Calgary, and Edmonton. So it's important to understand that you can't take a blanket statement across all of Canada. Each city is behaving differently depending on how strong and what industries those markets depend on. And of course, Toronto is facing more of the brunt of the tariffs that we are facing right now. And so they actually had more of those strikes and job losses and all of that happen. Relatively, oil is not affected as much. So Calgary and Edmonton still continue to hold so far due to their elevated full-time employment gains. So rent increases for occupied units still reflect strong demand. So while advertised rents have actually continued to ease, and this is extremely important. This is what those comments in my last YouTube video were about, is we are not actually experiencing any rental drops. Why is that? You are wrong, and it's not that I'm wrong, it's just there's 2 types of rents. So while advertised rents continue to ease, this hasn't translated necessarily into lower rents paid by all tenants. So according to the stats, the average for a 2-bedroom occupied unit in the largest 7 CMAs were actually higher than Q1 2025. So this is primarily due to more tenants paying higher rents at turnover in recent years, thereby driving overall rent growth. So if you continue staying in the exact unit that you're in right now and your lease has renewed at a higher rent, this is why. But as far as the free market goes, they more respect the demand and supply that is happening. And so if you move across units, that's when you'll experience the rent drop. And I'm not going to go into each of these, but as you can see, all the markets have positive gains year over year. Of course, certain ones have high gains for 2023 to 2024, but relatively they're still very, very strong for this year. And this contributes still a lot to that actual on-the-ground inflation that you're facing as a renter. Now, in markets where low turnover and strict rent regulations, rents often rise sharply. When rents become available, landlords adjust rents to match current market rents, which are typically much higher than the regulated rents. However, these increases may also help offset increase in operating costs and cover rising turnover-related costs such as renovations and repairs. We notice this dynamic by analyzing rent control markets, so Ottawa and Toronto, comparing buildings completed after 2018. So if you're in these markets, buildings completed after 2018 is actually different from the ones before. So those ones are actually exempt from rent control, while similar buildings from 2011 to 2017 are subject to rent control. So in both cities, when rent control unit turned over, rents were typically raised to match those in newer exempt buildings. So now rents in older buildings are catching up with those of newer properties, with stronger rent growth in average turnover rent. So the rent gap between older and newer buildings has narrowed across major markets, while when older units become available, they're actually priced closer to that newer build supply. So in Vancouver, the gap was the smallest in 2024, just at 9% for a 2-bedroom purpose-built rental. In expensive, tight markets, affordability has deteriorated to the point where many new and moving renters are settling for modest savings by choosing the older buildings. Higher turnover rents in several major markets have decreased tenant mobility, leading to longer average tenancy periods and resulting in a more substantial rent increase when tenants do actually move. So in 2024, the rent difference between vacant and occupied 2-bedroom units reached 44% in Toronto, the highest in major cities. So there's a huge difference between vacant units versus occupied units right now. And in Edmonton, with higher turnover and no rent control, has the smallest gap at 5%. Now, signs that are pointing to this increase in turnover. So in 2024, October 2024, turnover remained at the lowest rate recorded by the Rental Market Survey since this data collection began in 2016. However, since then, stakeholders in several cities have indicated an uptick in turnover because of higher vacancies and incentives that encourage tenants to actually move. This is supported by an increase in availability rate for newer purpose-built rentals in Toronto. So this rate has recently grown faster than the vacancy rate since fall, which indicates a rise in tenant turnover. Now, looking at the vacancy rates that are set to rise further, where are we going to go from here? Over the rest of 2025, the rental market is also expected to be influenced by the slower population growth and changing employment conditions. As demand struggles to keep pace with new supply, the market will continue to remain in a period of adjustment. This is in particularly true to Ontario due to lowered international migration targets, especially in areas near post-secondary institutions. So having lived in Ontario myself, it's primarily around, I'm seeing a lot of heavy rent drops in, for example, university cities like Waterloo and Kitchener, and it'll also affect neighborhood cities like Cambridge and Brantford. So those cities 100% will be affected, and then a bunch of other places that are primarily driven by renters from universities. Now, newer purpose-built properties will face more pressure from longer lease-up phases and increased vacancy rates. While the market may have abundant supply in the short term, there is still a need to maintain momentum in new rental supply to meet the needs of future projected population growth and to achieve better affordability outcome for existing households. So I'm not entirely sure what future population growth they're talking about, because right now Canada overall almost has negative population growth. We're seeing people leave and we're seeing lesser people come here, and considering the negative sentiment in the market with a weak economy and huge amount of layoffs, I foresee that to be the reality going forward for a while. Now, talking about rent burden still growing in major markets, so stakeholders have noted increasing financial pressures on renters. As affordability pressures persist, more tenants are expected to turn to shared living arrangements, further boosting demand for 3-bedroom rental apartments. That is an interesting term because 3-bedroom rental apartments was not as popular an option before. 2 bedrooms is the ideal situation for growing families, and work from home couples, but now 3-bedroom apartments starts getting some boost as people try to get into shared living arrangements. And having lived around the world in different countries, some very, very expensive, this is actually a very commonplace arrangement. And now as Canada shifts into being into that phase of an economy that requires that, a lot of people are opting for that. So it's either this or people are moving back home to live in the basement with their parents. This shift may make it harder for smaller units to attract tenants as households prioritize shared living space to save money. So to monitor rental affordability, we calculated 2 rent-to-income ratios. So the rent-to-income ratio using average market rents. This is for 2-bedroom units from the labor force survey. So these rents reflect broader conditions in the market, and then a rent-to-income ratio that uses advertised rents. So these rents represent actual prices faced by new renters just entering the market. Now, the rent-to-income ratios are based on labor force surveys and are highest in Vancouver, followed by Toronto. The ratios in other rental markets are within a similar range. And since COVID, essentially in 2020, rent-to-income ratios have steadily increased across markets. So this shows that rent affordability has actually been getting worse still over time. And as you can see here, occupied dwelling, so it's basically occupied dwelling rent burden growing, so as you can see here, it is occupied dwelling rent burden growing in major Canadian markets. This is a mouthful. Rent to income ratios with labor force stats. So left to right starting in 2020 and then going up to 2025. So when it comes to Vancouver, you can see it used to be at 18.3%. It did drop and correct a little bit after that. And then now we are back up at 17.8% for this year. Edmonton, relatively much lesser growth, but continuing to trend up. And Calgary also continuing to trend up. So overall, we were at 12.6% in 2020. And now we sit at 13.7%. As far as Toronto goes, in 2020, we were at 15.1%. And for 2025, now we're sitting at 16.4%. And as far as Ottawa goes, we were at 10.9%. And in March 2025, we are still at 12.5%. So that's an increase. And then in Montreal, 10.9%. And then we're up significantly to 13.3% because we've seen rents go up across both rental types. And then Halifax is at 12.1% back in 2020, and now we are 13.9% for this year. So that is why the ground reality feels different despite all these reports coming out, because realistically, if you continue remaining there, you're going to experience increased rents. And so that concludes it for this video. Hopefully that sheds some light, not just on the Calgary real estate market, but also what's happening around Canada, what you can expect if you're moving across provinces or if you're just moving across rental units within the same city. It's a very different picture, of course, and when you stay in the same place, you continue renewing your leases with the same landlord, or you move across units. And this now will shed some light, draw some clarity to what you're actually experiencing. Of course, if you have any further questions and you want to understand either as a renter what you can expect and what your best choices are going forward, if you're trying to get towards home ownership and whether this is the right market for you, or if you're a landlord looking to invest in different parts of Canada or just Calgary, definitely reach out. My links are in the description. Book a consultation call. I would love to have that chat with you. I promise I'm very easy to talk to and I love talking data. So I look forward to talking to you guys for those who reach out, and I appreciate all the support. You guys commenting and having those discussions under these videos is what helps me to then draw inspiration and help you even more. So definitely do that if you feel like it and if you have some questions. And thanks for staying till the end of the video as always, and I'll see you guys in the next video. Take care.